Hello and welcome back to Market Insights by Prakash. I am Prakash Chaudhary, your NISM certified research analyst, and today we are breaking down all the critical macroeconomic data, institutional flows, and regulatory circulars from June 27 to July 5, 2026. Let's separate the noise from the data. This week, not one but three major triggers have fired together, and each one touches your portfolio directly. Number one, the US jobs data came in so weak that all of Wall Street had to rewrite its Fed rate hike expectations overnight. Number two, the US and Iran sat down for talks in Doha, and crude oil has just recorded one of its sharpest quarterly crashes in over a decade. Number three, SEBI has dropped a fresh circular that directly changes how unpaid securities in your demat account will be handled going forward. And the impact of all three, it's showing up everywhere, from Nifty to gold, from the rupee to your broker's back office processes. So stay with me till the end. Before going ahead, our analytics show more than 90% of our regular viewers aren't subscribed yet. Hit that button now to subscribe and support Market Insights by Prakash. The biggest trigger this week came on July 2nd with the US jobs report. The US Non-Farm Payrolls data came out a day early and it was a massive miss. The US economy added 57,000 jobs in June, about half of what the street expected. While unemployment ticked down to 4.2%, this signals a cooling US economy. The immediate market reaction, rate hike expectations have been pushed out from September to December. When expectations of lower US rates rise, the dollar weakens, and that gives support to gold, silver, and emerging market currencies like the rupee. That's exactly why gold climbed towards $4,200 per ounce, and on MCX, gold futures jumped 1.4 to 1.6%, while silver gained 1.8 to 2%. This is a textbook example of how domestic US data, something that seemingly has nothing to do with your portfolio, directly moves your gold ETF or rupee-based investments. Now let's move to West Asia. On 1st and 2nd July, indirect talks took place between the US and Iran in Doha, Qatar, where Qatar's foreign ministry said positive progress was made regarding the Strait of Hormuz, the world's most critical oil transit route, through which roughly 20% of global crude oil passes. The next round of talks will happen after 9 July as Iran observes funeral processions for its late supreme leader. Now look at the crude numbers. Brent crude fell to a range of $70.33 to $71.80 per barrel, and WTI to $67 to $68.7 per barrel. But here's the bigger picture. Brent dropped around $45 per barrel across all of quarter, the largest quarterly crash since the 2008 financial crisis. WTI fell around $31, its largest quarterly drop since the 2020 COVID crash. Now let's connect this to the rupee. India imports over 88% of its crude oil requirements. When crude gets cheaper, we spend few dollars and pressure on the rupee eases. Here's how the rupee moved this week. 94.58 per dollar on June 30, weakened by month-end importer demand. On 1st and 2nd July, RBI reportedly sold dollars near the 94.75 level, meaning it intervened to prevent a sharper fall. Pressure continued even after that intervention. By 3rd and 4th July, the weak US jobs data weakened the dollar itself, giving the rupee some breathing room. Remember this, crude oil, the rupee, and US jobs data form a connected triangle. Whenever one moves, the other two react. Now let's get into regulatory updates. First circular, issued on 3rd July. SEBI amended paragraph 46 of the master circular for stockbrokers. This governs how a broker handles securities you have bought but haven't fully paid for. Under the new rule, those unpaid securities will now go directly into your demat account and then automatically get pledged, locked into a special account called CUSPA, or a client unpaid securities pledgee account. Brokers must notify you via email or SMS. The maximum payment window is 5 trading days. Implementation is phased. Some provisions kick in 3 months after exchange guidelines are issued, others after 6 months. Second update. On July 1st, SEBI launched a settlement help desk facility to assist applicants filing settlement applications and understand the process better. Third, for the AIF sector, SEBI introduced an inoperative fund framework on 16 June. In simple terms, if a fund has fully wound up its investments but can't surrender its registration due to a pending tax dispute or litigation, it now gets a relaxed compliance status, cutting down on unnecessary costs. Fourth, comments invited until 21st July. SEBI has proposed raising the AIF investor consent threshold from 2/3 to 75% and widening the definition of associate to related party for conflicted transactions. All of this is still at the consultation stage, not final. I'll keep you updated as this gets finalized. Let's now look at the India's own macro numbers. GST collections for June 2026 released on 1st July. Gross collections came in at 1,94,812 crores, up 13.9% year over year. Net collections after refunds stood at 1,62,377 crore, an 11.2% growth. Here's the interesting part. Domestic collections grew only 6.5%, but the import-related GST revenue jumped 34.6%, signaling a sharp rise in import activity. State-wise, Maharashtra remained on top with 30,714 crores, and UP posted an impressive 19% growth. Now on to PMI data. PMI stands for Purchasing Managers Index, a survey-based indicator showing whether businesses are expanding or contracting. Above 50 means growth, below 50 means contraction. Services PMI Final numbers for June, released 4th July, came in at 57.4, slightly lower than May, but still in strong expansion territory. Manufacturing PMI, flash estimate 54.5, a 3-month low, down from 55 in May. Both numbers remain in expansion, but momentum is clearly slowing. That's a note of caution, not a reason to panic. One more big development worth tracking closely. US Ambassador Sergio Gore said on 30 June that the India-US trade deal is in its final steps, with only the last 1% of negotiations remaining. But here's a critical deadline to watch. US's temporary 10% tariff regime under Section 122 expires on 24 July 2026. If no interim agreement is signed by then, normal MFN, most favored nation tariff rates will kick back in, which are considerably higher. This deal is not signed yet. It remains a developing situation, so I can't confirm it's finalized. The moment there's a confirmed announcement, I'll update you immediately because this directly impacts textiles, pharma, and IT sector. Let's look at what institutional players did in June 2026. In first half of June, FII sold net 63,450 crores in equity segment, whereas this situation turned around in second half of June and they bought 14,111 crores in equity segment for the first time after February. So to summarize this weak US jobs data, Iran-US Doha talks, the crude oil crash, SEBI circulars, strong GST numbers, and an approaching trade deal deadline. All of these are interconnected, and they will continue to drive the market into the next week too. If you found this weekly digest useful, please like this video, subscribe to the channel if you haven't already, and hit the bell icon so you can never miss next Saturday's video. Let me know in the comments which of this week's update was most relevant to you. Until then, invest wisely. Thank you.